All right, let's get into it. A $4,000 account climbed past a million and then disappeared just as quickly. Here's how it all went down. Literally. When he started, nothing about his trading looked unusual. No oversized positions, no wild entries, no "I know something the chart doesn't know" moments. Just a trader working with a balance. Small enough that every dollar mattered. $4,000 doesn't give you room for fantasy. You feel every pip. You feel every dollar of drawdown. And you definitely feel the pressure of knowing a single mistake can erase an entire week of gains. So he stayed disciplined. Almost unusually disciplined for someone starting that small. Small positions. Defined stops. Candle close entries. Nothing extra. He wasn't trying to impress anyone. He wasn't trading for screenshots or recognition. He was simply trying to survive. And ironically, that survival mindset created the foundation for the run that followed. Because here's the thing, the market rewards consistency, right up until the moment you start believing it owes you something. Over the first few days, his account nudged upward in small, controlled steps. A few dollars here, a few dollars there. Nothing flashy. More like someone quietly sweeping profits into the corner, hoping the market doesn't notice. But something shifted when the balance crossed into the five figures. Not a personality shift, yet, but an awareness. The awareness that the numbers on the screen weren't just numbers anymore. They were becoming possibility. You could almost feel the moment he started sitting a little closer to the screen. Not in an anxious way, pas in an alert way, like someone who just discovered a rhythm in the market and wanted to see how far that rhythm could go. And that rhythm did continue. For several days, the price action behaved almost politely. Trends held, pullbacks were clean, momentum lined up. There are rare periods, any experienced trader knows this, where the chart feels like it's speaking one language. No mixed signals, no confusing structure. Just a market moving in a way that makes sense. He caught one of those windows, and he traded it well. His account climbed from 10,000 to 18,000, 18 to the mid-20s, 25 to 38. Every step reinforcing the idea that maybe, just maybe, he was reading the market more accurately than he ever had before. And you know what? At that stage, he actually was. He wasn't guessing. He wasn't overtrading. He wasn't trying to force setups. He was simply following structure with near clinical discipline. But as with most trading streaks, the improvements weren't just on the chart. You could feel the psychological shift happening underneath. His risk tolerance stretched slightly, not recklessly, more like someone testing the temperature of the water instead of diving in head first. A slightly larger position here, a slightly tighter stop there, a bit more confidence in holding through minor pullbacks. All of it made sense given how well the market had been behaving. You could almost picture him leaning back for the first time, thinking, okay, I think I've got a read on this. Not arrogance, not ego, just familiarity. And familiarity is a dangerous comfort in trading because it can quietly inflate your confidence without announcing it. Still, for now, everything was working. The balance crossed 50,000, then 75, then 100. And at each step, the market kept giving him just enough confirmation to believe the trend wasn't done with him yet. This wasn't a reckless sprint, not yet. It was a trader who'd found momentum in both the market and himself, and was now riding both at the same time. As the balance kept growing, the pace of the entire story picked up. Not suddenly, more like a steady tightening of momentum. From 100,000, the climb to 150 felt almost routine. And that's the first trap of a winning streak, when big gains start feeling normal. He began trading with a little more freedom. Not recklessness, just loosened edges. Holding winners a bit longer. Letting pullbacks breathe. Sizing slightly larger when structure aligned. All of it made sense, but you could also feel the market giving him a confidence he hadn't had before. His trades became more decisive, his entries smoother, his exits cleaner. Every candle felt readable, every pullback predictable, every breakout familiar. It wasn't luck, not at this stage. It was rhythm, structure lining up consistently, and a trader locked into that rhythm. And the market kept feeding it. The balance hit 200, then 300, then into the high 300s. At this point, you could almost hear the soft hum of Discord notifications. The kind that go off when people notice you're doing something impressive. Screenshots started circulating. People asking, how? People asking, what strategy? People asking, bro, teach me. Recognition has a weight to it, and it's subtle at first, more of a shift than a shock. Because once people start watching, your trades don't just represent decisions anymore. They represent expectations. And expectations can be heavy, but he handled it well. He didn't jump into risky setups. He didn't try to perform. Not yet. He stuck to structure. He trusted what had worked. He kept his head down. But under the surface, something was building. Slowly, quietly. Because once you've turned 4,000 into hundreds of thousands, you start wondering what your ceiling actually is. And that question? That question is dangerous. His exposure increased, not dramatically but consistently. A bit larger in trends, a bit more confident in continuation moves, a bit more willing to stack positions when momentum lined up, and the market rewarded it. The account crossed the $500,000 mark, then 600, then higher. At this size, every candle carries weight. Every pip means something. Yet everything seemed to keep aligning. You could almost sense the intensity building around him, the kind of focus traders get when they know they're in a flow state and don't want to break it. And then came the run that turned a strong streak into a once-in-a-lifetime move. US 30 opened with strength. He caught the breakout early, sized responsibly, but large enough to matter, held a perfect pullback, added again, then added a third time. It wasn't reckless, it was calculated. Clean trend, clear structure, momentum behind him, and when that move extended farther than anyone expected, his equity spiked past seven figures, $1 million from 4,000, and the reaction from others was instant. Chats lit up, notifications rolled in, people screenshotting his equity curve and captioning it, "The guy who cracked the code." But recognition changes how you trade, even if you don't notice it happening. Suddenly he wasn't trading only for himself. He was trading in front of an audience. Not because he wanted one, but because success creates one. And once you become the guy who turned 4,000 into $1 million, every new position carries a psychological weight your older trades never did. The higher the balance climbed, the more fragile that identity became. Now he wasn't just trying to win, he was trying not to lose the story that had formed around him. And this is where the story shifts again. The moment his balance crossed $1 million, something subtle changed. Not in the market, in him. When the number gets that large, your relationship with every future trade changes. A $10,000 candle is no longer just a candle. A $20,000 pullback isn't just noise. You feel everything. And the higher the account climbed, the more he hesitated in places he never hesitated before. Because now every choice carried weight. Don't lose this. Protect the account. Don't mess up now. These thoughts aren't loud. They whisper. And whispers shape decisions quietly. He wasn't trading badly. He was trading cautiously. Maybe too cautiously. Sometimes the shift from confident to careful is the first crack in rhythm. Meanwhile, the market kept moving. But something else moved too. The tone of the candles. The structure of pullbacks. The feel of liquidity. If you've traded long enough, you know this texture. The chart feels different in the days leading up to NFP. Wicks get longer. Pullbacks get sharper. Breakouts fake more often. Not enough to scare you. Just enough to warn you. But in the excitement of his run, he didn't notice the shift. Or maybe he noticed, but didn't think it applied to him. That's not ego. That's momentum. When your timing has been right for weeks, you start trusting your rhythm more than the conditions themselves. So when he saw the next clean setup forming, almost identical to the one that carried him upwards, he stepped in. Sized well, waited for confirmation, let the candle close, entered, but spreads were already slightly wider than usual. Not dramatically, just by enough to matter. He didn't see it, and why would he? He'd been right for so long. The market, however, wasn't behaving the same. It wasn't noisy, it was unsettled. A kind of quiet tension sits in the chart before major news. Moves feel too clean, pullbacks feel too controlled. Everything feels suspended. And then it happened, a subtle change in price behavior. The candle that should have held didn't hold perfectly. The wick that should have been small stretched a little too far. He adjusted his stop, not widened, just shifted. Price snapped back in his favor. Relief. Still good. But what he didn't recognize was this: volatility was compressing. Hard. Across the market, spreads were tightening and loosening in waves. Liquidity was thinning in areas that usually stay stable. Order flow pockets appeared and disappeared faster than usual. This is where the psychological trap deepens. When a trader has been right for weeks, the mind shifts from, "I'm following the market," to, "The market is reacting the way I expect." Not arrogance, just the inertia of success. So he didn't step back. He didn't reduce size. He didn't pause. He held. And the market, just hours from NFP, kept compressing. The candles grew denser. Volume thinned. Structure became deceptive. And if you listened closely, metaphorically, but also literally, you could sense the energy shift in his chart. Because trends don't die with noise. They die with silence. And the silence in the market this week was unmistakable. He held through it, positions stacked, exposure rising, confidence telling him he had this under control. But the truth was simpler. When you've been right for weeks, the quiet feels like an invitation, not a warning. And this is where the story tightens one last time, before everything breaks open. And then NFP day arrived. Not with noise, not with volatility, but with a calm so sharp it felt unnatural. Anyone who's traded long enough knows this version of quiet. It's the kind that presses in around the candles, like the market is holding its breath. He didn't step out. He didn't reduce exposure. He didn't clear positions before the release. He held everything. Not because he wanted to gamble, but because the streak had taught him that holding was often rewarded. And in the final seconds before the news hit, the chart went unnervingly still. The candles stopped flickering. The spread drifted outward a little. Even the broker feed felt like it was waiting. Then impact. Price snapped. Spreads blew out. Liquidity evaporated instantly. The first tick sliced straight through his stops. But the real danger wasn't the hit. It was the slippage. Stops weren't stops. Limits weren't limits. Everything behaved like it was sliding on ice. His equity didn't fall in a line. It fell in cliffs. 1,000,000, 700,000, 400, 290,000, 40,000, 12, 4,000, 300. And then everything froze. Margin call. Account wiped. Silence. Traders don't explode in moments like this. They go quiet. Because the mind needs time to understand what the numbers just did. And when it sinks in, the shock isn't dramatic. It's hollow. Like someone stepped out of their own thoughts and watched from across the room. He wasn't ruined. He wasn't broken, but he was disoriented, the way anyone would be after watching a life-changing number vanish in seconds. He didn't rage. He didn't post excuses. He didn't defend anything. He simply went offline. And that reaction was the most human part of the entire story. Because when you strip away the hype, what's left is something every trader eventually faces. A moment where the market reveals how much of your confidence was built on conditions that were never going to last. The collapse didn't happen because he was reckless. It didn't happen because he didn't know what he was doing. It didn't happen because he ignored structure. It happened because the market conditions changed faster than his mindset did. Big wins accelerate confidence. Momentum blurs caution. Success builds a version of yourself that feels real, until the market snaps you back to the rule that never changes. The market doesn't care who you became during your best run. It only cares who you are when conditions shift. And during NFP, conditions don't shift politely. Here's the tonic. Anyone can catch a streak. Anyone can multiply an account when the market is speaking clearly. But the real skill, the skill that separates traders who stay in the game, is learning to treat a winning streak like the most dangerous environment you'll ever stand in. Because wins aren't the reward. Structure is. And the moment you start trading like the streak will protect you, you're already standing at the edge of the cliff.